Markets are looking at the Fed to determine whether or not they're going to pump or dump, and it all comes down to rate cuts. I believe that the Fed is going to cut rates in September, and in this video, I'm going to tell you why. I'm going to give you 3 reasons as to why I believe this and why I think you should stay convicted as an investor and not get shaken out in this volatility. If that sounds good to you, you know the drill. Hit the like and subscribe button down below, and we're going to hop into today's video. Now, the first reason why I feel so convicted that the Fed is going to cut rates in September is because the continuing weakness we're seeing in the labor market. We did a video on this last week explaining that the labor market was showing signs of weakness, and this has only continued to be the case. On your screen, we're seeing initial jobless claims. This is how many people are initially filing for unemployment. And you can see that we've kind of been in a range here, but this doesn't tell the full story. When you look at continuing claims, how many people continue to file for unemployment, what we see is that this is actually trending higher. Now, there is something to be gleaned here. Not all claims are created equal. I've got Danielle DiMartino Booth. She's going to break down what the difference is between continuing claims and initial claims. 30 seconds, take a look.
In many cases, the answer is no. States spent an extraordinary amount of money in the aftermath of the pandemic hitting the U.S. economy, and states are much more reluctant to approve a jobless claimant. And that is why we look much more at the continuing jobless claims, people who have gotten through the process and are receiving continuing jobless claims, as being the truer indication of the state of the economy.
And so what she's saying there is that continuing claims paints a much clearer picture about where the economy is. And with continuing claims continuing to surge to the upside, we're painting a picture of a weaker and weaker economy. This is giving the Fed a reason to cut rates. I think this is going to be probably the most pertinent reason that the Fed does cut rates. Now, another key piece of data that can give us insight into the strength or weakness in the labor market is the non-farm payrolls rate. This is the number of jobs added or lost, excluding farm jobs in the United States. Have a look on your screen. What are we seeing? We're seeing a decline, and we're seeing kind of a sharp decline really since halfway through 2024. Strong jobs here, and then we're just declining really for, almost the last year. Now, what this is telling us is that less and less jobs are being added to the labor market. This is showing signs of weakness. However, what the Fed looks at is the unemployment rate. Powell has been very specific about this. He says, we want to see unemployment rate trending higher before we cut rates. If we're going to cut rates to help stimulate more growth, we need a reason to do so. We need to see unemployment rate trending higher. The problem here is that the unemployment rate will continue to stay steady because we're losing workers as a result of the immigration policy. So even though the jobs are falling, the amount of workers that are available to take those jobs are also falling, keeping the employment rate steady. So we've got Mohamed Al-Arian. He's going to shed a little bit of light on this for you. 30 seconds, have a listen.
So I look at the labor market. The only indicator that allows me to sleep at night is the unemployment rate. 4.2. Everything's remained steady. It has remained steady, and that's the number he's looking at. But if you look at other indicators of the labor market, if you listen to what the companies are telling you, if you look at what's happening to people graduating from college, this is a labor market that is softening at an accelerating rate. And we have to be careful about this.
And so what Al-Arian is telling us, right, is that there are other things you want to consider besides the unemployment rate when you're deciding how the labor market is looking. And one of those things that he mentioned was that college grads are having a hard time finding work. Have a look on your screen. Young male college grads are now jobless at the same rate as non-grads. For women, it's looking actually a little bit better. So for the 2 women who watch this channel, happy for you there. But for the rest of you fellas, it's not looking so good. College grads are having a hard time finding jobs because there's weakness in the labor market. They need a boost, they need a bump, and the Fed should give it to them. Now, the second reason, and probably the most widely talked about, is the fact that the Fed is concerned that tariffs are going to come through in inflation. The fear is that tariffs will impact the prices of goods and services, driving up the prices that come through to retail consumers, and therefore driving up overall inflation. The Fed is trying to keep their target of 2%, but right now we're floating around 3%. The Fed's concern is that tariffs will continue to drive this up. However, experts are saying, and the Fed has even acknowledged themselves, that tariffs are only a one-time price increase. It's similar to a tax. It's a one-time increase in the prices. It doesn't contribute durably to inflation. But that being said, yes, we are going to see some inflation come through as a result of tariffs. And we're already seeing this in the data. The consumer price index last week and the producer price index last week were both showing signs of inflation. And if you want to learn more about the PPI report last week and why I think that it's not really a concerning signal, even though it did come out hot, have a look at our last video. I break that down and what you need to look at there. But that being said, we are seeing some inflation come through. However, this shouldn't be a reason that the Feds tighten rates. I've got Jeremy Siegel, professor at the Wharton School of Business. He's going to talk about why he thinks the response from the Fed should not be a tightening of rates and why they should look through the data and understand that tariffs are just a one-time price increase. Jeremy Siegel here, have a look.
I mean, I do think there's going to be a point, maybe a 1.5 bump in the CPI. It's going to be a one-time, but that doesn't mean the Fed should tighten for that. That does not call for a tightening. I mean, the money supply is increasing actually slower than it should. There's no other signs of inflation going on. So I think this whole idea, do we see the tariffs in the data? Everyone's saying, do we see it yet? Like, if we see it, the Fed should tighten is really just totally barking up the wrong tree.
And so what Siegler is saying here is that it is misguided for the Fed to continue hiking rates in an effort to stop tariffs coming through to inflation when we're not even seeing it coming through in the inflation. We saw headline CPI last week come in below expectations. We saw PPI come up above expectations, but that was mainly due to other components that didn't have anything to do with inflation. And so that is why I am confident that the tariff-driven inflation fears that we've been seeing are not really going to materialize in the Fed keeping rates higher. I think the Fed is done worrying about this, and if they are still worrying about this, it's going to be a policy mistake, one that I hope they don't make. And so that brings me to the third reason why I think the Fed will cut rates in September. And this one, speaking of policies, is maybe a little bit more of a controversial take, but I believe, and some macro experts are actually starting to talk about this, that maybe the Fed's 2% inflation target isn't the right move. Maybe we're moving to a world of higher inflation. Maybe we're starting to accept that maybe 2.25%, maybe 2.5%, maybe even 3% is the new inflation target. The Trump administration is going to appoint a new Fed chair. They've already got 2 Fed governors in there that are appointees from Trump, and with Stephen Mirren set to be confirmed, we're likely going to see a 3rd Fed governor from the Trump administration. And the Trump administration has signaled to us that they are more comfortable with higher inflation. I've got Jordy Visser, he's going to talk about this. 30 seconds, take a listen.
Now the market is starting to realize that every release that goes, there's more and more evidence that the administration is willing to tolerate a higher inflation rate. So I'm talked about it this week with many people. I believe you have to start believing there's an unofficial, unannounced higher inflation target.
An unofficial, unannounced higher inflation target. And with more Trump appointees coming onto the Federal Reserve Board, I believe we're going to see more and more thinking in line with this expectation. And so that leads me to believe that even in higher inflation that we're seeing now won't stop the Fed from cutting rates. Remember that the Fed, we're still at about 4 to 4.5% rates. To cut 25 or 50 basis points isn't getting us all the way down to zero. It's not going to send inflation crazy. It's just going to give the economy the little boost that it needs to help the labor market get out of trouble and to help the markets along. Inflation is not necessarily a big concern right now, and many experts agree with this take. And so for these 3 reasons, that the labor market is cooling, that tariffs will not contribute to inflation, and that the inflation target may be getting adjusted higher unofficially, are the reasons that I think the Fed are going to cut rates in September. And I also believe that we could see more cuts this year. I think we could very well see cuts in October and in December. We just don't know yet. We're going to have to wait and see what the data tells us. And if you want to stay up to date with the macro data in the months ahead and get valuable insights as to what to expect as an investor, be sure to like and subscribe to this channel. Leave us a comment down below. Let us know what you've learned. And as always, thanks for listening, and we'll see you in the next one.